How's it going, everyone? Welcome back to another dividend investing video. On this channel, we've been covering some of the most interesting companies for dividend-minded investors and dividend growth investors. But as an American investor myself, my focus has been primarily on the American stock market, the New York Stock Exchange, and the NASDAQ. You can invest in many American companies that have plenty of international exposure. But what if we want some true international exposure in our dividend stock portfolios to markets outside the US? The first natural place to look is just to our north, to our friends in Canada. There are some fantastic companies that fit in a well-balanced and diversified portfolio, and today I'm going to go over 3 of the strongest choices available, so let's get to it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The main stock exchange in Canada is the Toronto Stock Exchange, or the TSX. It is the 10th largest stock exchange in the world and the 3rd largest in North America. As of August 2019, the TSX had 1,569 listed issuers with a combined market capitalization of $3 trillion Canadian. The largest 60 companies on the TSX are called the S&P TSX 60. This is sort of a Canadian version of the American S&P 500. There are several ETFs listed on the TSX, but none that I could find listed on the New York Stock Exchange or the NASDAQ. Now, Canadians can invest in ticker XIU on the TSX to invest in this index. Now, luckily for us American investors, many great Canadian companies are listed on both the TSX and on the New York Stock Exchange, making it easy for American investors to gain ownership in Canadian companies. For American investors, before we go and buy Canadian dividend stocks, it is important to understand the tax implications. This is an explanation from simplysafedividends.com, and I think it explains it well. Dividends paid by Canadian companies to U.S. investors are subject to a 15% withholding tax. Taxes should not be withheld on dividends in your retirement accounts, so your traditional or Roth IRA is a good place for these types of investments. However, if you do choose to hold these in a taxable account, American investors are usually eligible for a foreign tax credit to offset that withholding, and Canadian dividends are generally qualified dividends, taxed at your long-term capital gains rate, so as long as your shares have been held for at least 61 days. I should also point out the iShares MSCI Canada ETF by BlackRock that is available to American investors with an expense ratio of 0.5%, though this is too high for my taste. But they do provide a nice hands-off way to access 94 Canadian companies, and notice the TSX is very heavy on financials and energy. That is a trend you're going to see with Canadian companies. Now, friends, I do want to know down in the comments what Canadian stocks are in your portfolios. Alright, so let's look at the companies on today's list. Stick around until the end. I'm going to review 2 additional bonus picks that I think are worth adding to your watch list. Stock number 1 is Toronto Dominion Bank, ticker TD, on both the New York Stock Exchange and the TSX. TD Bank Group is a Canadian multinational banking and financial services corporation headquartered in Toronto, Ontario. The bank and its subsidiaries are simply known as TD. The bank was formed in 1955 via the merger of the Bank of Toronto and Dominion Bank, which were founded back in 1855 and 1859, respectively. And it's one of the so-called Big 5 banks of Canada. It's the largest bank in Canada by total assets and market capitalization. In Canada, the TD Canada Trust Division serves more than 11 million customers at nearly 11,000 branches. And in the U.S., the company operates via their subsidiary, TD Bank North America, which serves more than 6.5 million customers with 1,200 branches in 16 states and Washington, D.C. So for TD, listed on the New York Stock Exchange, year-to-date shares are down about 3.8%. And over the last year, shares are down 18%. So could this be an opportunity, a long-term opportunity in TD stock? And from the TSX side of things, the performance year-to-date shares are down about 4.7%, but for the last year, shares are only down 11.75%. So I wonder if the difference here has something to do with the value of the US dollar versus the Canadian dollar. I don't know, but I suppose if you're an American investor, you're basically stuck with the New York Stock Exchange version, and Canadians are stuck using the TSX version. As far as I know, if I'm wrong, feel free to explain in the comments and I'll follow up on that. Now, for the purposes of the following stats, I'm going to be using the New York Stock Exchange version going forward for TD. Let's see how the stock is valued. Shares of TD are trading at a PE of 9.2. This is a nice 14% discount to its 5-year average, looking like this could be a decent time to start a position or add to an existing. Investors can collect a 4.58% yield at today's price, and this is 16% above the 5-year average dividend yield of 3.96%. Another indicator of a potentially undervalued stock. Potentially. TD pays out this dividend on a quarterly schedule in the months of January, April, July, and October, and they make a payment of 96 cents per quarter for a total annual payout of $2.82. This is in Canadian dollars, so Americans are at the mercy of the conversion rates. Here's a history of how the dividend is paid out in American dollars. You can see how it's kind of like an ETF that pays a different amount each time. That's one thing you'll get as an American investor in most foreign companies. Now, TD's dividend makes up 42% of forward earnings, just a hair above where we'd like it to be, ideally 40% or below for a company like this. But notice, with the exception of the fluke year in 2020, they pay out a very consistent amount of their earnings. That's very consistent. SimplySafeDividends.com provides us with a safety score of 80. This site is far more generous to most of these Canadian banks than they are the average US bank. And also I'll note that this is the highest dividend safety score TD gives to any of the big 5 Canadian banks. Now, for the part we love as dividend growth investors, TD has been paying this dividend uninterrupted for over 166 years. That's without a reduction. They have a dividend growth streak of 12 years of raising that dividend payment. It was maintained during the Great Recession between 2008 and 2010. TD's revenue has nearly doubled over the last decade, when they have been doing $25.6 billion in sales in 2013, and over the last 12 months, they brought in $48.1, doing better every year, except for, again, that fluke year of 2020. We all know what happened that year, right? Now, in terms of share buybacks, TD, at least, is not diluting their shareholders. The amount of shares outstanding has slightly declined over the last 10 years, only slightly, but not really buying back any shares. Wall Street analysts rate the stock a 4 out of 5, which is a buy, out of 6, 12 rated a buy or strong buy, 3 a hold, and 1 a sell. The average analyst price target is $70.06. This is for the New York Stock Exchange listed version. That's 13.53% upside from today's prices. So that's TD Bank, and I think this is looking attractive today. The big 5 banks in Canada all have some appeal to income-minded investors and really deserves a video on their own. If you'd like to see me make a video comparing all 5 of these banks, let me know, and I'll get on it, okay? All right, stock number 2 is Canadian National Railway. On the New York Stock Exchange, we're talking about ticker CNI, and on the TSX, it's ticker CNR. The Canadian National Railway Company engages in rail and related transportation business. They were incorporated in 1919 and are headquartered in Montreal, Quebec. The company operates a network of 20,000 route miles of track in Canada and the United States. And I see this company as sort of the Union Pacific of Canada. And if you've been following our videos, then you already know that UNP is one of my all-time favorite dividend stocks. I'm a huge believer in investing in the railroads, the moat they have, and the efficiency on which they can move significant amounts of cargo. Just checks all the boxes and their dividend growth as well, a lot of these companies. Now, performance year to date. On the New York Stock Exchange side, shares are up about 3.24%. Looking back, though, the shares are down last year about 3.5%. But if you look at the version listed on the TSX, CNR, shares are up about 2.2% year to date, and they're also up about 4% over the last year. Again, I'm not sure why American investors would be down over the last year while Canadian investors are not. And I'm not going to pretend I know things I don't. I just know I can only invest in CNI on the New York Stock Exchange as an American investor, at least easily. And the rest of the metrics below will be following the CNI ticker. Okay, so shares of CNI are trading at a PE of 21.2, sitting right around the historical 5-year norm of 20.5, suggesting the stock is sitting within its own fair value range. Today's shares of CNI yield about 1.92%. It's 8% higher than the 5-year average, so not looking like we're in discounted territory, nor are we looking like it's in overvalued territory. Right? Perhaps I'd like to see that starting yield above 2.1%, I think, for me to be opening a position, locking it in at least 15% better than that average starting yield. The dividend is paid out quarterly in the months of March, June, September, and December in the amounts of 79 Canadian cents per share for a total annual payout of $2.36 Canadian. And as I showed you with TD, that's going to look different for American investors each time due to the USD to CAD conversion rate. The dividend makes up 41% of forward earnings and 50% of forward free cash flow. Both are well below the 60% threshold we'd like to see for these companies, looking fantastic from both of those perspectives. Now, SimplySafeDividends.com gives us a safety score of 97, seeing the dividend as very safe. They do note that if Kansas City Southern's deal goes through, due to how this is going to leverage them, they might downgrade this from safe to very safe, it's like a score of like 80. And I'll talk about that more after I go over a few more of these metrics. CNI has been raising their dividend payout for 26 consecutive years, which would make them a dividend aristocrat, but I don't think they are officially on that list as a Canadian company, but it is impressive nonetheless, especially with double-digit dividend growth rates over the last 5 and 20-year stretches. The 5-year average annual dividend growth rate is 12%. That's pretty awesome, right? CNI displays the kind of healthy revenue growth you want to see for a dividend growth investment, with $10.6 billion in sales in 2013 and $70.1 billion over the last 12 months. CNI also buys back a sizable chunk of shares every year over the last decade. The outstanding share count has declined by 18% over the last 10 years. Wall Street analysts rate CNI a 3.5 out of 5, just barely a buy. Out of 32 analysts, 11 advocate for buying, 19 for holding, and 2 for selling. The average analyst price target is $126.61, which is about 3% from current prices. I see CNI as a fairly valued stock at this time. Reasonably valued, not a discount, not expensive, and maybe a good place for some Canadian exposure. Should also point out they recently won a bid to acquire Kansas City Southern for $34 billion, beating out rival Canadian Pacific's bid for $31 billion. And this merger, if successful, will make CNI the third largest railway in North America, and just look at the size of the network from Halifax to Vancouver to New Orleans, all the way down into Mexico. So we're going to keep an eye on this. Stock number 3 is Sun Life Financial Inc., ticker SLF, on both the New York Stock Exchange and the Toronto Stock Exchange. Sun Life Financial is a financial services company that provides savings, retirement, and pension products worldwide. It also offers term and permanent life, as well as personal health, dental, critical illness, long-term care, and disability insurance products. The company provides financial advice, asset management, and investment-related products as well. It also involved in the mutual fund and investment management business. Sun Life Financial was founded in 1871 and is headquartered in Toronto, Ontario. Performance year-to-date for the New York Stock Exchange flavor, shares are up 4% year-to-date. That's about the last 4 months. And over the last 12 months, shares are down about 11%. Now on the TSX side, year-to-date, shares are up just below 3%. Year-to-date, shares are down about 4%. And going forward, the rest of the stats I'll be speaking about are for the New York Stock Exchange ticker. Okay? So in terms of valuation, shares are sitting right at the historical norm of PE of 10.1 at the moment, but the dividend yield is 4.44%. And this is 16% above SLF's 5-year average dividend yield of 3.83%, suggesting this could be a good time for income-minded investors to invest in Sun Life. SLF pays out its dividend in the months of March, June, September, and December in the amount of 72 Canadian cents per quarter for a total annual payout of $2.14 Canadian. So this will be a little different each time it's paid out to American investors. The SLF dividend makes up 45% of forward earnings, and ideally this is below 15% for insurance companies, so that checks off any concerns with dividend safety. Now, SimplySafeDividends.com gives Sun Life Financial a safety score of 89, rated very safe. Sun Life has 8 years of consecutive dividend raises and 22 years without a reduction. The dividend has been growing at a rate of 10% on average over the last 5 years, and their last raise was at 19%. So they're checking off all of our boxes for dividend growth. The shares outstanding are also on a slight decline for the last decade, reduced from 614 million in 2013 to 589 today in 2023, though they haven't really bought any back in a couple years. Now, SLF is covered by 16 Wall Street analysts, 8 rated as a buy, 7 a hold, and 1 a sell. The overall rating is 3.62, a buy. The average analyst price target is 45.72, which is about 5% below today's price. It looks like they may only be using one price in that, so take that for what it's worth, guys. Now, if you are looking to add an insurer to your portfolio and get some foreign exposure at the same time, if you're an American investor at least, Sun Life Financial makes a ton of sense for income-minded investors. But just remember those implications for holding Canadian companies if you're an American investor on the tax side. All right, now thanks for sticking around this far. I'm going to share with you two more really awesome Canadian dividend stocks that I think belong on your watch list. The first is TELUS Corporation, ticker TU on the New York Stock Exchange. This is a way to add telecom exposure in the communications sector. Think of these guys as the AT&T or Verizon of Canada. They've been around for over 100 years. They have better dividend growth metrics than their American counterparts. Extremely consistent growth here, growing at an average rate of 7% per year, which would normally beat inflation like most of the time at least. And you're getting a starting yield near 5%. And last, I want to briefly look at Enbridge, ticker ENB on the New York Stock Exchange. Enbridge is the oil and gas storage and transportation business, considered one of the best run midstream companies in North America. They've paid out their dividend for 70 years without a reduction. Although growth is slower these days, you would be locking in a starting yield today of 6.65%. So this is definitely one to consider for more income-oriented investors who want some pipeline exposure from Canada. Consider Enbridge. This dividend does appear to be easily covered and has a Simply Safe dividend safety score of 70. Now, folks, if you value this content, please help me out. Like, subscribe, comment, and just do all the things that help me out. The algorithm, they've been really harsh on me for this last month. The channel growth has really slowed down, but I'll continue to bring you the best content I'm capable of making here for dividend growth investing, and I hope you all have a wonderful day. And until next time, keep investing.